Assalamu alaikum warahmatullah. So, continuing with what we were discussing, Ijarah Accounting, Financial Accounting Standard number 32. So, paragraph 5 says, what is Ijarah? Some essential components of the Ijarah. So, these are the four broader components. It has to be a contract which transfers the user front, that is the benefits associated with the using of the asset, of an identified asset, right? So user fund should be transferred, user fund should be transferred, control must not be transferred. So the asset remains in the control and ownership of the lessor. There has to be an identified asset, there has to be a period of time, either in terms of lapse of time or in terms of usage. For example, such and such kilometers per kilometer for 200 kilometers of usage for a car in exchange for some consideration. So these are the four basic pillars. Some do combine them in three, some do say they are four. So thus the contract transfers the user front, right? Then eventually, if there is a contract which is a package contract in which there is a lease as well as there is some sort of maintenance plus some sort of toll manufacturing, then how they are to be accounted for. So paragraph 5 to 11 actually guide us in detail about this. So they say that first of all we have to see if there is a sort of an user fund transfer. It means the Ijara component. If so, then we have to separate the Ijara component and non-Ijara component based on their standalone market prices. So for example, the example is coming that a total agreement is for 100 rupees. Then we have to see how much should be of 100 should go to Ijara and how much should go to non-Ijara services. So we have to see the standalone prices. Okay, so let's say standalone price of the Ijara in the market is 60 and standalone price of non-Ijara in the market is 80, right? So particularly these services. So the ratio comes to 6/8, which is 3/4. So now the $100 or 100 rupees will be broken down in the ratio of 3 into 4. The three part of 3/7 will go to Ijara and 4/7 will go to non-Ijara. But there is a special exemption, a simplified approach which is available to lessee, not the lessor. The lessee may elect to treat Ijara and non-Ijara component as a single Ijara component to reduce accounting burden. So to reduce administrative and accounting complexities of recording the Ijara and then recording Ijara rentals and depreciation on the amortization on the Ijara and non-Ijara expenses. So the standards allows that the lessee can treat the entire contract as Ijara, right, and apply the Ijara accounting. So what the Ijara accounting is, it's coming in the further slides. So some of the reflections to you according to paragraph 5, what are the 3 or 4 essential criteria that must be met for a contract to be identified as Ijara? There is a scenario as well. Another question: an Islamic bank enters into an Ijara contract for a large industrial generator. The contract includes the right to use and a separate monthly fee for professional technical maintenance and refueling services. Based on paragraph 7, how should the institution... Okay, so here is another example of how do we apply the suppression rule, again generated by notebook LM, and it says that there is a package contract of $150,000 in which there is an Ijara component as well as there is a daily calibration services as well. So we need to decompose this. So the decomposition has to come up with the standalone market prices. So if the standalone market prices are 120 and 30, coincidentally 120 plus 30 is 150, but it's not necessary, right? It can be 140, it can be 70. So the standalone prices in this ratio, actually we will divide this 150 and the Ijara component will be accounted for as per the Ijara accounting rule, that and right of use asset will be debited, will be recorded on the right hand side of the equation. Lease liability, Ijara liability will be recorded. At what amount recorded, it's coming in the next slide. And of course the non-Ijara components are merely the services, so they will be recorded for every period as an expense, right? Now here is something very important about the simplified approach, right? So when we say that there is a package deal, then lessee is allowed to treat the entire package, which has Ijara plus non-Ijara components, as an Ijara component. Now what does it mean from the accounting perspective? That the entire lease contract, in which there are some non-lease items as well, will be recorded as an asset, ROU asset. and a corresponding liability. Of course, the recording will be at the present value of future payments, which we shall see in the next slide, measurement slides. So this is allowed, right? This is something allowed, and the rationale for allowing this, AAOIFI says that it is allowed because to make the life of the lessee simple. But on the lesser part, it's not allowed to club the two and record the two as a sort of a lease income, right? So for the lesser, it says that the lesser are strictly forbidden from mirroring this simplification. They must allocate consideration to Ijarah and non-Ijarah components on a relative standalone price basis. Why this is so? Because a physical asset can be rented out, and a rent can be charged on it. But if the seller is also providing some service, then the seller cannot charge rent on the service. So that's why the service has to be definitely separated from the non-service part, from the Ijara part for the lesser. But for the lessee, keep in mind, for the lessee, it is also a requirement, but there is a relaxation available to the lessee, and that relaxation is not available to lesser. So lesser, if this is the contract, then maybe the lessee can treat the entire 150,000 as a sort of you say uh, entire 150,000 as a combined contract, right? A combined Ajara asset of one present value of 150,000 Ijara liability, and then periodically it vanishes up. But lesser cannot. Lesser has to divide this into an Ijara income and non-Ijara income. And the exact counting, treatment, measurement, lesser, they are coming in the upcoming slides as we are following the sequence of the paragraphs. So moving forward. So here is an example, simplified approach for IT equipment class. So the example says that these are the books for the lessee. These are the books for the lesser. The lesser is an Islamic bank. The lessee is a company. So the lessee can combine the two. They capitalize 100% of the contract value as a single ROU asset. This is the relaxation available to the lesser, but the available to the lessee. But the lesser has to separate the components and record the incomes. So that's the income on the lesser side. They have to record the income separately. Then the types of Ijara, it says paragraph number 12 that it can be an operating Ijara in which no transfer of ownership asset returns to the lessor at the end of the life. Then there can be an Ijara MBT, right? Muntahiya bi Tamlik, expected transfer, and Ijara MBT with gradual transfer, which is a sort of a diminishing Musharka Ijara, right? Diminishing Ijara. So transfer during the term, for example, diminishing Musharka, it means that some part of there will be a common asset. Some part of the asset, 20% of the asset will belong to lessee, 80% will belong to lesser. So the lessee will be paying rent on the 80%, and along with rent, it will also buying some percentage of the asset. So the next period, the ratio will be 2377. The next period, the ratio will be 2674, and this way, end of the period, entire asset will be transferred. So the graduate insight, why there is no finance lease. So Sharia strictly prohibits combining two transactions, the lease plus sale, into one contract. In an Ijara MBT, the lessor must retain ownership risk throughout the term, right? So if it's talking about this MBT. If there is a gradual transfer, then the ownership risk divides between the two according to their ownership components. Moving forward, right, there are an example of an operating lease, airline lease for 5 years, returns the aircraft, residual value risk always. So this is the operating lease, the first one. The second one, airline lease for 10 years. Crucially, the airline signs an independent unilateral promise to purchase the aircraft for $1 at year 10. So this is usually not on the part of the airline. It is usually on the part of the the leasing institution. They say that they will sell you at $1 at year end, right? So the lease and the promise remain legally separated. So in the finance lease, they are one contract in the conventional sense, but in the Ijara, they are separate. But inherently, they are to be together. Uh, and if it is a gradual transfer, a sort of a diminishing Ijara, then they co-own the asset and gradually the asset transfers. So determining the Ijara term. So now the point is that there is a binding period. For example, the binding period can be 5 years, and then there can be some non-binding period, some optional period in which the lease can be extended. So from the accounting perspective, we need to decide what has to be the life of the asset, because we have to depreciate the asset in that life. We have to take the present values according to the period. So now the guidelines are available in the standard that how should we work out that what's the actual period. So it's not just the legally binding period. What they say, the total Ijarah term is the contractually binding period plus reasonably certain extension period. Extension period, which is not binding but reasonably certain that the lessee will extend its lease, right? And the lessor also. Reasonably certain non-termination options. There are termination options as well. For example, it can be an option that after 6 years, the lessee can terminate. Lekin, should we go forward beyond 6 years or not? We have to see if the termination option is likely or not. So again, there are some guidelines, right? So institution cannot rely purely on legal text. They must assess economic incentives to extend. So how do we say whether we take 5 years or complete 10 years or 8 years? So maybe the extension time period is 5 years. So here are some of the helps. Are optional periods priced significantly below market rates? If this is the case, of course, it means the lessee is going to exercise it. Are the major unamortized leasehold improvements, if during the lease period in the fourth year there is a huge improvement in the value of the asset, maybe on the part of by lessee or by lessor, whoever owns that percentage, it means the asset is intended to be used further. It means the life is going to be extended. Are termination costs, relocation penalties, or business interruptions cost prohibitive? If I terminate the lease, will it be too much costly for my business? It means most likely I'm not going to terminate. So these are some of the factors. Is the asset highly specialized or location critical? If the asset is highly specialized, it means nobody else is going to use this asset. So for bank and for the lessee also, it is usually certain that the lease will be extended. So these are some of the tips that are available. And here is an example for this. The scenario is a private healthcare provider signs a 5-year Ijarah for building with a legal option to extend for another 5 years. Right. So now, what period should we take? 5 years or 10 years? The facts are that the provider spent $5 million installation, leading lines, walls, and custom MRI infrastructure. Relocation to a new facility would cost $7 million. It means that if for a period of 5 years I have taken an asset and I have also spent the asset was for 5 million and I have also spent 5 million further in order to keep it operational, then of course it is reasonably expected that I will extend. So the period will be taken as 10 years, because otherwise the termination costs are very prohibitive. So the conclusion is that despite the strictly legal binding period being only 5 years, the massive economic penalty of moving creates reasonable certainty of extension. So these are all the tips which the underlying rule is, the underlying principle is that the period is not only the legally binding period, it has to be account for the reasonably expected extension period which the lessee is going to take the asset. Some other indicators given in paragraph number 15 and 16 of reasonable certainty is that historical precedence, the past practice of lessee, combined features. Combined feature means when combined with a promise to purchase, ensuring total payments are roughly equal whether extended or not. So maybe sometimes there are features that even if I terminate the lease, the lessee being the lessee, if I terminate the lease in the extension period, end of the day I have to pay the same amount, right? There is a termination penalty. It means I am not going to terminate the lease. So this is another tip. And short binding periods, when the initial binding period is exceptionally short relative to the asset's utility. If the asset is a huge asset, for example, and the initial binding period is very short and it is not operating Ijarah, then again it is reasonably expected. So these are the tips which help us decide. Any express intention by lessee to exercise an extension opinion legally provides reasonable certainty. So another thing, right, which is more tangible, is that if the lessee express his or her or its intention that it will going to exercise the extension period, then it is sufficient. No further evidence is required unless there is something on the contrary exists. So that's it for this video. In the next video, we shall see the further provision beyond paragraph 16. Thank you.